Alrighty, folks, we are going to have a deep dive on all the various topics around housing crashes. We're going to talk demographics, credit cycles, distressed, existing versus new home sales. We're going to have this conversation with Logan Matsushima, lead analyst with Housing Wire. How you doing, buddy?
It's good to be here.
I told you this privately, but I'll say it here for the video. Your engagement and willingness to deal with crash bros on a daily, if not hourly basis is admirable and something I could never do.
No, nobody does it. Nobody has the mindset to do it. But I've done this for like 12 years. This is going to year 13. So it's so much fun for me because when you know you have a group of people that don't forecast and don't really show anything or have no models, you could constantly take them on. And I used to be worried that maybe these people will start reading and realizing maybe they shouldn't like try to take me on. And then that was probably the worst call I've ever made in my life. They will not stop until they go into the afterlife. And I am here for it. And I was thinking that after the horrific thing about home prices crashing in 2023 didn't happen, that they would all shut up. That after the 12th year, my broken clock theory, because I've documented this every single year, why the reasons that they give and why maybe they'll shut up in 2024. And they didn't. And I was going to let it go. I was just going to let it go and just, okay, you guys do whatever you want. And they wouldn't shut up. So I thought, okay, the next 10 years, it's war now.
Right.
It is absolutely, I'm going to get every single one of them in a live debate until I die. We're going to get their forecasts. We're going to get their models. And I'm going to prove to you that they're trash because these are not housing people. These are doomsday porn people. So the one thing they can't do is actually forecast or give their names and faces or anything, right? So I was going to be fine. I was going to let it go and just say, okay, I'm going to go my way. You guys go your way, whatever. After 2023, you got, and they couldn't. And now we're like, home prices crashed in 2023. And I was like, okay, that's it. That's it. This is going to be a 10-year project of accumulating almost 23 years of bad housing crash calls. And then saying this is a one-trick pony and this is really just for engagement. These people don't even believe this stuff. They don't forecast anything. And I was so invigorated by their, what they were saying early on in 2024 that I was like, oh my God, thank you. Thank you for giving me a path and an energy way to do this for another 10 years. And absolutely guns of Navarone. I am going to unleash hell like I've never had because I was fine with letting it go and they couldn't shut up.
Well, we're going to get into all of the kind of big buckets, at least that I've seen. You may have seen others, because I want to break them down. Kind of reading is a good thing, but before we get there, I want to ask. Obviously, you're the lead analyst at Housing Wire, but Logan, are you a real estate investor? Do you own rental properties? Are you a real estate investor? What say you?
It's the funny thing about this. I tell everybody, I am the worst real estate investor ever. I have one rental property. I own free and clear. I have never raised rent on this since 2013. And I live in Orange County, California. You could raise rent and make some money here.
No, yeah, you could.
And I didn't collect rent for 2 years during COVID. I had to put in a new AC and all these things. So I am the worst real estate investor ever. This is basically just economic cycle work, right?
So you're
and this is why I always say that if you actually correlate all the housing crash people, there's only one common theme. They're either Russian trolls or they're anti-central bank people. There's no kind of in between here, right? The scale of them is one group of people, and I could prove it. I did prove it. I kept all their work for 12 years, and they're never going to change. This is who they are. And living in America after 1913 for some people has been such a pain that they have this dark black hole in it. And no matter what you throw in there, nothing fills it up. So every day is basically doom porn. So I said, okay, advantage, disadvantage. Let's throw forecasts and models out. They can't do it. They cannot do it. And they just don't shut up. And that's what I love about them. They can't let it go.
Yeah. So again, you have one rental property you bought back in 2013. You don't have a growing portfolio. You're not part of syndications.
No.
Any calls that you make are economic. You don't have this Logan's book, lower
And
rates
and
helps
and,
Logan
and
in some
here's
way.
here's a good test case for that. There was only one person that I remember as an analyst talking about we need higher rates in early 2021. There wasn't anyone else that was saying, listen, we are at such low levels of active listings that this is not
Yeah.
a good housing market. And then I'm the only person on planet Earth in 2022, before the Fed actually pivoted and said that we need higher rates to blow this system up to get some kind of, because back then we were running at what we're going to run 20-25% home price growth because
Yeah.
we
It's
had
crazy.
75% plus. So throughout the whole year, and everyone could go look at my quotes, I literally, with my name and face, because I'm not a coward, I said, not only do we need higher rates, we need rates to stay higher to put home sellers, builders,
Yeah.
and investors on their ass.
Yeah.
Recorded. Because I would look at it at the economic side of housing, not the investment side. Like price things are not that relevant to me. The economic cycle in terms of construction jobs, new home sales, those things, and housing demand and the incomes that flow in and out of it. That's more of my work. I'm not a
Right.
price first person. So I've got all the receipts. I have all the receipts for 12 to 13 years. There is nobody on planet Earth that could go head to head with me. And I encourage it. I want it. You have no idea how much I want this engagement now more than ever.
Yeah. Yeah, so let's get into some of the topics. Again, you have this running 12-year clock. The broken clock wasn't right in 12 years, so they're even worse than a broken clock, but now they're repeating themselves. And the first one I want to talk about is the silver tsunami, right? It's going to be demographics. It's going to be the baby boomers selling their McMansions to the broke millennials that is going to cause the housing crash. I think they called this first, I don't know, 5, 6 years ago. It seems to
Well,
be the topic of 2024.
yeah, it's an interesting thing. The silver tsunami actually was created in 2008.
Oh, wow.
And it was now the reason why they used 2008 is because the first baby boomer hit 62. So
Oh,
it was
okay.
something that was designed for 2015 to 2025. Now, not a lot of people remember this, but the silver tsunami was a downsizing. All the boomers were going to downsize to broke millennials who couldn't buy avocado toast, and home prices had to have a major crash. It wasn't about death. we're
Hmm.
in we're like 2 years away from this cycle ending. And the reason that they take the AARP and they take the surveys and they say, oh, all these baby boomers are going to list their house, it never really occurred. The distribution of death selling is not that much anyway. If you read or anybody reads, they could see that. So it was a failed premise. The problem is the inventory went the other way. So instead of using the NAR data, 26 to 32 million active listings during this period, we're a tad above a million. So the
Right.
whole thing failed, but for marketing purposes, it works. Like everywhere when I tour the country, there's one variable that's constant. Everyone asks me about the silver tsunami, about what happens if all the baby boomers sell at once and everything, because it can trick people, even though
Yeah.
it hasn't really worked for so long. So I understand the tactical advantage of using it. I question the merit, especially from people who don't track housing inventory. Like new listings data was trending at the lowest levels ever the last few years. Even this year, it's not anything big. So I thought the best way to go after this is to actually show what a tsunami looked like in new listings data. And that's 2008 to 2011. And mind that 99.9% of the people in this country or this planet do not have that data. We do. So advantage, disadvantage. They're playing in my field. This is my
Right.
kingdom of heaven. Now all of you get to see what real data looks like versus a speculative theory that doesn't work. And we get to do this every single week this year. So I thought this is going to be one of these things that we do for the next 10 years is to correlate people's theories based on what the real data shows. And they can't get out of this anymore because
Yeah.
let it go.
Yeah, I think the silver tsunami is interesting to your point. It's one of those threads that kind of intellectually makes sense. And you're like, oh, yeah, they're getting older. And oh, yeah, they got to sell and all of that. Not realizing there's more and more people attacking it now. But I think the average age of a baby boomer today is 67. The average life expectancy today for a 67-year-old is 21 years. So if this is your theory, are we talking about another 10 years from now?
You
Right?
know,
It's like, it's
yeah,
crazy.
in the next decade, you're just going to get more and more people dying, right? But I always say that what their children do with the house is what we're going to have to figure out
Exactly.
when that occurs. But but again, the silver tsunami was a 2015 to 2025. Like this was the period in time, and inventory slowly kept on going lower and lower and lower. And again, To me, like everything changed in housing after 2010. I just don't think people have the training or the
Mhm.
discipline to actually talk about housing economics because it actually takes work and you actually, have to run with data lines that they don't have. I mean, if you look at a lot of people copy and paste things from other websites, they don't have any models of their own. We have a live tracker that we talk about every single week. We're
Mhm.
the ones who wrote the COVID-19 recovery model on April 7th, 2020, based on certain things that were happening on the day. Highlighted November 9th, 2022 was going to be the structural shift of this, not only for the housing market, but if you're in the recession cap, if the builder survey data starts to rise, boy, your recession model is flawed. So at least
Yeah.
we can actually get people into focusing on things that matter. But I know out there, the speculative theory, the blood and guts, that's what
Yeah.
draws the attention in. And this is why the only way to take these people out is in live debates. Then you get
Yeah.
forecasts and then you get and then they're done.
We've got to,
Finished.
yeah, we've got to shine a light on the doom porn. I mean, again, if you get a theory that sounds good and you scare people, it can cause bad decisions, and this is
Well,
just one of
here,
those.
here's an interesting aspect. When people ask me, should I buy a home? I have
Ah,
I have I have the same answer. I always say no.
yeah, me
And
too.
then and then
Yeah,
they go, well, what do you mean? I said, well, first of all, I have no idea who you are. You're just asking me. Mind that 67% of these people are trolling men who just want to say,
yeah,
they have no intention of buying. So I already know that per se. So I say that millions of people buy homes every single year. There's nothing in the data that I see that there's a vast amount of people sitting on the sidelines fearing something. When
hmm,
rates go up, demand falls. When rates go down, demand picks up. But there's a core, 45 million total home buyers that are here always.
yeah, always.
And why are they buying and you're not? So to me, when you're asking me, you're asking somebody who doesn't know you, doesn't know your finances. My first and only answer will always be there's nothing wrong with you renting for the rest
Yeah,
of your life. Not only that, think about the freedom and sleep you will have renting, not worried about prices falling. I mean, as you have to be a functioning adult. So there's so many things to worry about in the world. You don't need to worry about this.
yeah,
But I know that person in Ohio right now who bought a house, that person is ready. Why? Because it's a 30-year fixed payment. It's the cost of shelter. All
yeah,
the variables that go into this decision, you're the only person that can make it. So if you're asking somebody else, I'm going to say, not ready now, not ready ever. When you stop asking people if you should
yeah.
buy, then you're ready, right? Because people do it every single year, every week, people make that decision. So
Yeah.
I just fundamentally do not believe you're emotionally or financially ready to own a home.
Yeah, I tell people I get asked almost every day, should I buy a home? And I'm like, dude, if you're asking a guy on the internet, if you should buy a home, the answer is no, because you're
Yeah.
not ready. It's pretty
Yeah, and
wild.
that's why I say like a lot of people think that all these people that got scared. Now, I've run into people that have said I didn't buy because of COVID. It's such a small minuscule of people. And then I think so basically mortgage rates were very low. The total cost of housing was very low, but you were worried about prices, not the payment, right?
Exactly.
And you didn't pull the trigger and now everything has changed. That's on you, dude. Don't
That's
blame
on
anyone.
you.
Don't blame that kid on the internet that told you home prices were crashing in December 2020.
Yeah. Yeah.
You're the one who didn't pull the trigger. You don't look at anybody else but yourself in the
Yeah.
mirror. It was your choice, not anyone else's.
I love that. We will get into that topic, but the next one I want to go to is I think it's their new favorite chart. You've definitely seen this. The chart is about new home prices, but of course they want to make it about homes and existing homes, and it's been the largest drop on record. Home prices have fallen. I'm sure you've seen this chart. Pretty frustrating.
This is where I think it's funny because this brings me back to 2018 and 19. And if people go look at real median new home prices, the median sales price, it was actually falling noticeably. And people actually back then, mostly stock traders, were saying, oh my God, home prices are crashing everywhere. Housing bubble 2.0 crash actually started in 2018. I mean, I've done this for so long. I remember every debate I had back then, and people were just like, and I was like, no, new home prices really are, but the median sales price, well, part of that is the makeshift. So just to keep things very simple for everyone, there was a group of people shorting the builders that said that prices are crashing and that their profit margins will get destroyed. In real terms, if new home prices were crashing and then the builders are spending so much money for the rate buy down, wouldn't their profit margins go significantly lower?
Yes. That's how
Wouldn't
it
they?
works.
I mean, that was the whole Ivy Zellman's, housing demand is a mirage, inventory is going to skyrocket, the builders can't play, that was the whole premise. And what happened? It completely backfired in the biggest fashion ever. Why? Because nobody who is serious uses the census median sales price. No one who is serious does it. This is why Case-Shiller, FHFA, Zillow, Freddie Mac, Fannie Mae, AEI, Black Knight. This is why they were all created for the existing home sales market. So we created like Fight Club rules 2 or 3 years ago. I was like, oh my God, people don't even know that the new home monthly supply data is just for new homes. And they think that there's like 7, 8, 9 months of monthly supply. That's there's no housing, there's so much inventory. I was like, no, that's for the new home sales market. Not so then I realized something else. There was all these people posting that there's more homes under construction than ever. So they think that there's a flood of single family new homes that are going to be completed, unoccupied, and hitting the market. And I was like, and this I believe is my fault. I didn't talk about this in the past because I thought that, God, somebody must have read a new home sales report in the last 15 years to know this. The builders do not flood a marketplace with completed homes, right? There's a whole process of building. They manage everything. And then even during the housing bubble crash years, even in 2008, this data line never got to 200,000. And I was like, oh my God, either they're purposely lying or they really have never read a new home sales report. I'm starting to get in the camp that they've never really read a new home sales report because there's nothing in the data that we see this, right? You start a project, you're under construction, that home is already on contract. If it gets to the marketplace with the contract being gone, you usually find a buyer. They're what I call efficient sellers. So
Yes.
there's so much. I mean, it's funny because I always think like dealing with Russian trolls in the past, they have gotten away from this, right? Not even they're doing this. There's only one group of people that do this every single year. And this is why we say name, face, forecast. Give me the last 5 or 10 years. If you can't do it, don't listen to them.
Yeah. Yeah. One of the things I want to talk about new home sales that I actually hope happens, and I'm just curious if what your forecast is showing is I hope folks like follow Lennar's kind of trend setting where they're building smaller footprints. Maybe not the 660 square foot home like San Antonio or 997 like Paradise, Arizona, but build smaller. But the outcome of that will be new home prices fall further. I mean, it's like
Yeah.
predictable, right?
It's actually back, when I did my housing work back when I started in 2010, I had a basically core premise for this decade. It was going to be the weakest housing recovery ever because new home sales were so low and existing home sales were low. Affordability was so good back then when rates started to fall that people thought that sales would be booming. The household demographics really weren't there. They would happen in years 2020 to 2024. So you have to work it up.
Mm,
But what happened in 2014 is that the builders missed so badly on their sales estimates because they kept on trying to build bigger and bigger homes.
yeah.
And it didn't work because there was so much existing inventory, and that existing inventory is cheaper. That after 2014, they kind of said, okay, we're going to have to we have to stop this long-term down uptrend of, I think we got to 2,700 square foot house back then. That was the highest ever.
Mhm.
And then they started to provide bigger or smaller homes into the mix, and even construction of townhomes, right?
Right.
That being at the highest level since 2006, that in itself brings the median sales price. So part of the team higher rates in 2022, putting the builders on their ass was, okay, they were like cutting contracts at the end and raising prices for anyone that wanted to buy. We had to get them out of that cycle. And we did. So they cut deals. So I encourage everyone, if you guys go to my Twitter account and you see that pinned tweet that I did on CNBC in September, it said the builders sell their homes as a commodity. They do not sell their homes like an existing home seller, right? They have no relationship tied to it. They're here to make money because they are not the March Dimes. So now they are providing the homes that actually can
Right.
get them the profit margins they need. And it's a
Yep.
lot of times it's smaller homes. And this is how the system works out here. So
So be aware, folks, new home prices are probably going to be headed down. Don't fall for the Russian trolls and doomers. Again, new home sales, transactions, prices, it does not equal existing home sales. They're completely different markets. Is that fair?
yeah, absolutely. That's why, I mean, that's why everyone follows Case, Zillow, FHA, all these things that have rolling averages because, and it's just, wow. I thought there's nothing they can do in 2024 after what happened in 2020. And they took it to a level that, Oh my. And again, that's my thing for the next 10 years. So I hope everyone's going to get ready to be entertained because I am not forgiving this one after the last 12
Yeah.
years.
Well, it's funny. You actually gave them credit or acknowledgement that you think they just haven't read a housing report. I'll take the other side. I think they're lying idiots and creators of doom, but it is what it is. Let's talk about the credit cycle. Again, I started buying in 2002. I saw the credit cycle get crazy stupid. And it's been very different than the last 4 years. And I don't think enough people realize the credit cycle pre GFC and the credit cycle pre 2024 is night and day different, and they just don't get it.
I would say the biggest two variables in the entire US economy was the 2005 bankruptcy reform laws and the 2010 qualified mortgage laws. And once you go past 2010, everything looks different for a reason, right? And so one of the reasons why I said we would have the weakest housing recovery ever in terms of sales, construction, and demand in the previous decade is that we lend to the capacity to own the debt. That
Yep.
means all the speculative demand curve is gone forever. We can never have a sales boom like we did from 2002 to 2005. The,
Mm-hmm.
the credit availability index that spiked up in 2005 and 6 has collapsed. It's gone nowhere. So we just give 30-year mortgages. It's a fixed debt payment. Wages rise every single year. As people get older and their total incomes rise, that debt payment stays the same, but its net cost to the actual homeowner is less over time as their wages rise. So because of that concept is so rare to people that everyone naturally assumed that everyone was poor. And I constantly show the New York Fed data lines every single quarter, which people can't even read that it's a quarterly data line. They think it's 1 year old. Um, that it just basically shows the cash flow of those that own homes are so much significantly better than any other time in recent history. Forget about the nest equity and all that. There's no real recast rate risk. So when
Right.
we look back in 2002 to 2005, people forget that we had a massive credit boom, but the credit markets were breaking in 2005, 6, 7, 8.
Mm-hmm.
Then the job loss recession happened. And
Exactly.
because we had 4 years of credit buildup, and this is key for everyone, right? Because we have our own new listings data, and we always say we don't share to the public everything, but we're trying to like trickle this down to really make the case. From 2008 to 2011, the new listings data were running at 250 to 400,000 per week.
A
Per,
week.
per week.
Week.
Yes.
Yeah.
The last few years, it's running at 30 to 90K per week,
Mm.
right? So we have a period in time where we actually did have a tsunami, what we call as forced credit sellers, right?
Yes.
Then there was a portion of time where it was like everybody's just, hey, if it's their time to sell, they do. Are there people that are stressed? Of
Yeah.
course, people lose their jobs every single week, every single month.
Yeah.
There are those things, but in general terms, this is not the case. The credit market, this is why all my work revolves around credit cycles, because I'm trying to explain to inventory. I think you've seen me do this chart, the NAR's chart.
Mm-hmm.
Active inventory's peak was actually 2007. From
Mm-hmm.
that point on, we have been in a downtrend on inventory for a while. So naturally, people think, well, if you have the biggest home sale crash ever recorded in history, inventory should skyrocket back to 2007. It barely even grew if you use
Yeah.
the NAR data. And there's a reason for that is that shelter now, when you are basically locked into a qualified mortgage rule, you cannot list your house because 75 to 82% of home sellers or buyers, if you cannot afford that house, you're not putting that house on the market. End of story, right?
Exactly.
If you have to move or whatever, either you get compensated for that or you sell to rent. But in any case, the downtrend has been here for a while. So you test the theory in 2013, 14 when rates rose and demand got hit. Yeah, it didn't really move anything back then. 2018 and 19, it was funny because people thought that, home prices were crashing and inventory sky. Hardly anything happened back then either. But here was different. Here was the biggest and fastest home sale crash ever recorded in the history of America. We are in the third calendar year of not just great recession lows in demand, but I would argue the all-time lows in sales because our demographics are better and our population
Yep.
is higher. And inventory is still pretty much here. And I'm not a mortgage rate lockdown person,
Mm-hmm.
but the inventory channels can work with weakness in demand, days on markets growing,
Yeah.
accumulation, as long as that demand stays weak. Once demand gets better, right? The ability that supply and demand, and this is the thing I see, that the supply and demand equilibrium of housing, to me, it's so crystal clear, but I have the data to look at it all the time. For other people, they think that, okay, demand is shut down, inventory velocity will go up like it did back then. This was forced credit sellers, right? Okay, so that's why if you go back to 1982, if you look at the active inventory, it's always been in a clear, stable channel regardless. There was only one period in time in the history of America that that wasn't the case, and that was the credit boom and bust that we saw
Right.
from 2005 to 2008, and then the ongoing onslaught of new listings data, which were forced credit sellers, which could not buy a home. And that's the thing. Think of the supply and demand equilibrium on.
Yep.
Majority of sellers are buyers. That's how you work it together.
Yeah, the other thing, these individuals, they do just seem to be caught in everything's GFC or housing crash 2.0. They don't understand the distressed timeline, right? In
There are
2000s,
Yeah,
go ahead.
there are libertarian men that will give their lives away for 1929, 1987, and 2008. They don't care.
Yeah.
They
Yeah.
would give up all their personal goods if something like that happened just to justify their existence of hating the Federal Reserve and the government and everything. And my God, if Argentina destroys their Fed and they don't have it, think of all the passports and all these people that should be moving to Argentina because there's no Federal Reserve there, and they can enjoy their deflationary heaven or whatever out there. And trust me, none of them are moving,
No,
right?
they're not moving to
This
Argentina.
is a
And
this is a
Argentina is a lovely country. I've been there several times, but they're not moving. Where I
oh,
was going with though is all these people now are saying they're stuck on job loss. We're gonna have job losses, and that's going to lead to distressed sellers and cash out. And I'm like, folks, first off, their mortgage payment is below the cost of rent, so that's not going to happen. Second, the mortgage is an asset, not like last time where the mortgage was a liability. And third, um, all of these forbearance and all of these things didn't exist last time. And finally, last time the foreclosure process in many states averaged over 1,000 days. So even if unemployment spiked to 10% and everything else went wrong, you're talking like 2027, 2028 before
so
inventory shows up.
this is an interesting topic because this goes back to my COVID-19 recovery model, where I talked about, okay, game's on. We're going to recover in 2020 by the end of the year. So a lot of my smart economic friends, not my crazy crash friends, were saying, Logan, there's 20 to 30 million people unemployed. There's 5 million in forbearance. How do you think housing demand is going to come back? And I was go, oh, that's cute. Look at the army behind me. I have
Yeah.
133 million Americans working with 3% rates. You think they're going to sit there and
Yeah.
go, oh, because this person lost their job here, I'm not going to do anything. Within 6 weeks, the housing demand recovered back to pre-COVID trends on the purchase application data. 6 weeks, that is all it really took. So, um, when that time comes, this is why my recession model is really based on jobless claims getting above 323,000.
Mm.
Once that occurs, think about it in this light. By that time, whenever the recession does occur, we're going to have 158 million people working. We're
Yep.
going to have record low sales demands to work off of, unless the demand curve gets higher before then. That's the most home buyers ever in history, and they've been waiting for years. So
Yeah.
go back to that supply and demand equilibrium. Is it possible? Is it, this is the one question I ask everyone. Is it mathematically possible to have low active listings and stable demand and have home prices crash? Do we have anything in the last 500 years that
No,
has
that's
that has that? So think of it in that. Let's assume that rates don't go down and we get sellers. If we're talking about forced credit sellers, again, 30-day, 60-day, 90-day, 120 NOD filing, since
mhm.
all those data lines are near all-time lows, minimum 9 to 18 months before that
Minimum.
supply. Yeah,
Dude,
minimum.
in today's world, it's probably more like 18 to 36 months.
Yeah, and this is assuming no forbearance, no nothing,
Yeah.
no government, nothing. So
No.
this is something that has to be down the line. If you want to make a case of forced equity sellers, okay, but then you have to talk about the supply and demand equilibrium. That's what happened during COVID, is that
Mhm.
everybody said, well, inventory was held back, demand came back very quickly. You're
Yeah.
forgetting that aspect. And I think that's where I could see that they're not trained, right? There's no focus here. right? There's no supply and demand equilibrium discussion. This is why I always say that it's, the 4 million existing home sale level is really critical to my work for a very long time, because what happened after November 9th, 2022 is that whole forward-looking data was getting so bad that we're going to hit that level. And why that's important. We really don't have anything now in history that says this data line crashes below that. Why? Because if you're looking at, you need 106 to 114,000 median income, whatever, to buy a house, who do you think the home buyers are? Right? Dual household incomes. They qualify with that, right? Then you
Yeah.
have cash
Yeah.
buyers, you have investors, you have move-up buyers. And so when you put the dual household income factor into the equation, people like to say that the median income is here. And so you're basically formatting a single household income to every household in America. If everyone was single, then they
Yeah.
have that income. Well, what if I add two incomes in together? Oh my God, their faces. Go, what?
Yeah.
Yeah, put two incomes in there together. This person makes 75, this person makes 90. What is that? Calculate that. What's that
Yeah.
median income then? So
Well, you have
they're
stumbled
explaining.
across the chart that lights me on fire. This is the one that pisses me off, and it's getting quoted more often. It is that income to price metric. I freaking hate that chart because that's meaningless. It's not affordability. It doesn't have interest rate. It's single person, like you say, versus dual. I mean, that chart, again, it's back to the silver tsunami. It has a thread of truth that people can lock onto that means nothing. It drives me crazy.
It shows a lack of experience. So the one way I explain it is this: who are the 5 million home buyers last year? Total home sales existing and new is near
Mhm.
5 million. Who
Yep.
are they? Right. So again, it's an interesting gimmick. It works a lot. But when you think of home buyers, right? Think of a lot of dual household. Why? Because the majority of home buyers are married couples.
Yeah.
And we have
Correct.
more dual household incomes than ever. And especially what we call the DICE, double income college educated. So in that context, that explains why total home sales, even with the biggest crash in sales ever recorded in history, is still 5 million with new and existing homes together. So this has been a big talking point of mine for a long time. They like to put renters, the lowest income renters, single household renters, into the mathematical equation of all of
Yeah.
home buying, and they don't forecast home sales because they've never done this. It's a nifty trick they do. They basically are telling everyone that the median income is the set total person in the entire country, right? Not the fact that there's a upper portion of the median income.
Yeah.
So the scale is the buyer difference out there. There's your 4 to 5 million home buyers. Again, which will still kind of be here. So imagine if rates fell in that environment with, I'm not a pent up demand person ever. I've never liked the theory, but we literally have people that want to buy homes. They just need lower rates. So in
Hmm.
that context, we saw a glimpse of it toward the end of 2022 to early 23. Mortgage rates went from 7.37 down to 5.99. It gave us 12 weeks of
Yeah.
positive forward data. The builders have shown us the way, but it needs sub 6% mortgage rates. This is why I'm very hesitant to go into this. Okay, we're rebounding in home sales or anything. I just can't fundamentally get the 10-year yield to break certain levels to get to those mortgage rates. So when that occurs, you're going to see what we've always seen post 2010. Rate of change, lower rates, more buyers into the mix where demand is. If it was 6.5 million, it's different. That's a very hard level to contain. But when you're working from the lowest levels of
Yeah.
sales ever, boy, it does not
It
take
doesn't
much
take
to move.
much.
Doesn't take much to move the needle. But even if it doesn't move the needle, it means the demand is stable. So you're going to
Yeah.
need a couple other variables to come into play to get that home price crash theory out there. And again, I don't see the experience. I
Yeah.
don't see people that track housing. I see really, really creative professional doomsdayers, but there's a way to single them out, and you just name, face, forecast.
Yeah.
5 to 10
Yeah.
years. That's all you need. They're
Yeah.
done.
I want to talk about some trends more recent, maybe back to December 15th of 2023 to today, because I think we have even more recent kind of data to look at it. And we obviously saw rates crack in December. They went down to about 6.6, I think was kind of the low average. Then they raced back up to 7. What I saw in my weekly review, and again, I talk to agents, brokers, all of those every week, is we were starting to see some bad behavior, right? Clearly at 6.6, my words, not yours, marginal demand was coming off the sidelines at a rapid clip. and the inventory wasn't there. So we were getting bidding wars, waiving EMDs. We were getting bad behavior again. I don't know if you saw that in the data or not.
This is the unfortunate aspect of having active listings still near all-time lows. Now, for us, Altos Research, Housing Wire, we have our own data lines. And when I explain to people, our inventory levels have doubled from the lows of March of 2022. We had 240,000
Yeah,
single-family
it's a
homes available,
500.
and
Yeah.
now
Yeah.
it's a little bit under 500,000. That is still historic low. There are parts of the United States of America that really have not moved much. And
No,
in those areas, even if demand rises just a little bit,
smidge. Yeah.
you still have what I've always said this whole period is about. We have too many people chasing too few homes. It wasn't,
Savagely unhealthy, I think
yeah,
was
it
your word.
was, yeah. So it's a construct that people don't realize. Housing broke out before COVID-19 hit us. People don't
Yeah.
remember this, but if we had no COVID-19, we would have had actually more home sales in 2020 than we did because COVID-19 had to delay. We would have had
Yeah.
less home sales in 2021. So just think of it as this. If inventory breaks to all-time lows with population at all-time highs and demand stays stable, flat, really, you still have too many people chasing too few homes. If demand increases, guess what? You have a bigger pool with this variable into truth. So this is the one variable factor that going back since 1790, here is the truth of it. Inventory broke to all-time lows in America. That did not happen any other time in recent history. Demand was stable. That means too many people chasing. There's your bidding war. So
Yep.
I mean, there's no real way to get out of it. This is why I'm so happy that inventory is growing. Like I am such a pro supply person. I love any market that's back to 2019 because it creates the equilibrium balance that I thought being part of team higher rates in 2021, doubling down in 2022, why we needed to create that is because all this does is it forces prices to be higher than it should be. And then that eventually kills demand. I mean, it's not a shock that home sales crashed in the biggest fashion ever recorded in
Hmm.
history in 2022. We had prices escalate out of control, rates spiked. There's no more exotic loan debt structures. Buyers are legit. Those buyers come off
Yeah.
the pool every single 1% higher out there.
Yep.
So, and
Exactly.
they come back in with every 1% lower. But the variable that's staying the same is active inventory is still low. And even new listings. If anything, new listings data is slightly disappointing me this year. It's growing on a year-over-year basis, but I expected a little more. I do expect new listings data to pick up a little bit more as active inventory. And we're getting back to a somewhat of a normal market, right?
Mm.
Compared to what we've had to deal with. Inventory growing, the supply and demand equally, and we work off of that because it's really hard to get home sales to crash from like 4 million to 2 million.
Yeah.
That
No.
did
No.
occur in the 1980s, right? But we
Mhm.
had a lot,
81. Yeah.
yeah, we
81.
had a lot less people back then. So it's just a little bit different now. And again, just always remember dual household incomes. Married couples are the biggest home buyers. One
Yep.
income, two income put together. Look at the median income chart. There's your buyer out there. It's not a lot. 335 million people in America, 158 million people working, 4 million home sales in the
Yeah.
existing homes. It's not asking much.
Yeah. The other thing I want to talk about active inventory, because this is something that I've kind of keyed on is kind of above and below the median, right? We've seen active inventory. I think it was up 18% year on year, 1% or 0.1% week on week. I am in my discussions, we're seeing inventory above the median show more growth than below the median. And again, that's obviously metro specific. I don't know if your data cuts that way, but are you seeing, I don't think it's rising equally above and
I
below the median.
here's my thing. I hate using percentages when we're
Mm,
working from such low levels because it makes it look like a lot. So
yeah.
I always like to use the raw active inventory. We're
Okay.
getting inventory growth on a year-over-year basis. It's not a lot, but it's growing.
Okay.
And we should just all be grateful about that. Now, of course, Texas and Florida are the big
Mm,
drivers. Of course, we all know what's
correct.
happening in Florida, especially, post a hurricane. But in any case, if I take those two states out of the equation and even New Orleans, it's not a lot. And that's what
Yeah.
scares me is that we're really being pushed by two big population states. And I mean, we're looking at maybe 60,000 more homes, 60 on
60.
like
Yeah.
something to that nature where I think actually using the last week, we're probably at 420 more like 80,000.
Okay.
I prefer everything going back to 2019 levels because at that point we have a buffer.
Mhm.
Like we have a buffer because when rates fall, I cringe when I think if rates fall again, guess where we're stuck.
Yes.
And I just want, like, I love all the counties that are near 2019 or other, because then there is a buffer there. The sellers cannot have too much power,
Yep.
or especially if rates fall. So hopefully the year goes like I hope. And the reason I say this is that last year, since I'm not a mortgage rate lockdown person, I have to explain it. New listings data last year, even when rates going from 7.25% to 8%, was remarkably calm. It was
Mm.
we have all this crazy housing data, but the new listings data was just deadlining. Nothing
Okay.
was happening, right?
Mhm.
That to me shows that even with significantly higher rates, we still have that seller buyer that's out there, and it can't really go too much lower. So new
Right.
listings data is growing, inventory should grow, days on market should grow, and the forward looking data is showing this. The price good percentages are still down year over year, but more supply balances out the housing market. What I didn't like last year is that inventory was falling all the way to April 14th. And that's, home prices rose last year. And that's part of the reasons is that supply and demand equilibrium is still not back to a level that we could have balance in the marketplace nationally. And hopefully that explains what happened last year. Mortgage rates were 6 to 8% the entire year, and home prices were up by 5, 6% last year. I can't give you a demand theory with that. All I can say is demand stabilized and active inventory is still low. There it is. It's just that supply and demand equilibrium. So I'm very encouraged about 2024. I just need it to stick. And I hopefully that we don't have rates spike up again where people go, okay, that's it. I'm done with the year. And then new listings data just kind of goes back to the trend. Because remember, you as a person, as a home seller, if you're looking to sell to buy, you have to get pre-qualified now,
Yep.
right? You can't just put your home in the market and go, oh, wait a second, I didn't know if I was. So because of that, it's kept the new listings data kind of at bay when affordability is so stretched. And remember, affordability is not just mortgage rates.
Mhm.
It's property taxes, it's insurance, right?
Yep.
It's the total cost of housing, right? The purchase price that you're buying, how much your down payment, that revolves around all the how much home total housing costs will be. But in this case, we're okay for now. I just need inventory to grow for the spring and
Right.
summer to create some more balance.
Yeah, so I think what you're saying, again, correct me if I'm wrong, but if we can keep rates at or around 7%, the market could start to heal itself. And we need time. We need weeks and months, quarters to kind of get past this. Um,
Yeah,
what
higher rates,
yeah.
days on market's growing,
Mhm.
inventory could grow. What happened in
Yep.
2022 to 2023? Remember, home sales stopped crashing, right?
Correct.
That's the thing. So higher rates needs the weakness and demand variable to go into it. And again, you could only do this for so long because I always say the Fed has this COVID-19 housing policy. So people ask you, why doesn't the Fed ever say anything about housing? Go back to February of 2023. Neil
Mm.
Kashkari came on TV and said 6% mortgage rates is a problem for the Federal Reserve. Bowman, the recent Fed president, says more housing doesn't equate to us. The 1970s had labor force growth and had an
Mhm.
oil shock, but it had a housing boom. Okay,
Yep.
so when they talk about 70s inflation, they're not seeing an oil shock anymore. Jobless claims are low. They are sweating at night about the housing market. They do not want the housing market to grow in sales. This is why they don't really talk about it, right? And it's hard for me to get convince people that this is their policy because they're not used to this, right? We're always used to an accommodative Fed, but now that the growth rate of inflation has fallen so much, they're still not saying it. And that's how I explain why I'm not a Fed pivot person and why
Right.
the COVID-19 policy sticks. Because if you were thinking about the 1970s, not a pandemic inflation, the last thing you want are people having sex, buying homes, buying stuff, right? That's what the 70s was. That's why we had a massive housing boom. And here we have still the millennials and the older Gen Zs. They're still there. Other countries, Europe doesn't have this, China doesn't have this, Japan doesn't have this. They don't have a young replacement workforce or consumer to push their inflation. Here we do. So they're a little bit mindful of that. And that does explain their hesitancy to ever say anything positive about the housing market going forward, or trying to say, okay, we believe we need lower rates. No, they are just,
Yeah.
and they're doing that for a reason.
Yeah. So let's play that thesis out. So we talked about if rates go from 7 to 8, what might happen, but let's just pretend for a moment rates go from 7 to 6. Does that kind of unleash unhealthy behavior again, and it really spikes marginal demand?
Home sales could go up. I would argue you need 4.75 to 5.875 for 12 to 18 months to have a significant change. What we saw with 6% mortgage rates is that demand picked up. We actually, it's weird to say this. We had one of the biggest month-to-month existing home sales prints ever
Hmm.
last year, March going into February. We were working from a very low bar. So you could get demand. And of course, when you're parts of the US that haven't had a lot of growth, the buyer pool picks up,
Yep.
right? And then
Hmm.
depending on where their inventory is, there's your problem, right? So there are parts of the country that are near 2019 inventory levels perfectly fine. That's
Yep.
why I root
Agreed.
for that. But there are certain parts of the country that don't have that luxury. There's where I don't see the 15 to 20% home price theories. Because that was a sub 3% mortgage rate. The
Right.
concern about rates falling is that we're missing about 4.2 to 4.7 million home buyers if we take the
Mm.
three channel and how demand has fallen back based on our demographics. Just the sheer size of those coming back in, depending on when it happens, can cause problematic issues for the
Yep.
housing market. But it's something we track. We don't see that yet. I still think that needs a sub 6% market place.
Okay.
I don't see the 10-year yield breaking or anything like that yet to have that discussion. But I am very, very mindful of that as being part of team higher rates in 2021 and 2022. I do not want to be part of that group
Mhm.
ever again, but I just don't see the 3 to 4% housing market activity here, even if rates did get down to 6%.
Very, very cool. As we wrap up this great discussion about housing crash and all of the ways that people say it's going to happen, curious about what your call is for 2024 and where can people follow you?
So I forecast every single year, name and face. We do a podcast, Housing Wire Daily. It's the top 10 business podcast. Housing Wire Daily, there's two podcasts a week. Housing Wire itself has all my work. If you want to get nerd out, Logan Moshami on Twitter or Instagram stories, we go over live videos of all the economic data. I'm an economic macro cycle person first, housing second. I was looking for 2024, 2.3% home price growth. I'm part of the higher kind of rate camp. So that was my forecast. That means real home prices in a sense would be negative depending on where inflation stands, just because rates are higher than I would say most people. And I'm a jobless claims 10-year yield channel guy. I mean, that's all I do is think
Mhm.
about this stuff. So if I don't seem very bullish on mortgage rates, it's because the jobless claims data is so low. So that's my forecast. The Housing Wire tracker that we provide every single Saturday for everyone on housingwire.com. It goes over active listings, new listings, price cut data, purchase application data, 10-year yields, economic data, how the forward-looking purchase apps look through demand. Our job is to look forward. We don't want to
Right.
be on the moment or back. We want to look forward. So when the market turns, right? Everyone,
Yeah.
we don't have to wait 3, 4, 5, 6 months like people did in 2023, like in the middle of June and July. They're like, oh my God, what happened? And it was like, homie, we told you this in November and December, right? Things are changing. So forward looking, positive or negative, doesn't matter. Housingwire.com, Housing Wire Daily Podcast. There's a YouTube channel for it now. If you care about nerdy economic data, I'm your guy. If you want doom
Mhm.
porn and all that stuff, I'm not your guy for that.
There you go. Well, I will keep following you folks. Housing Wire, Logan, he's the man. I will keep blocking people and just watching you take them on head on. You are amazing, Logan. Thank you so much.
Pleasure.
Thanks.